please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But moving on, Sebi will be holding a crucial board meeting later today, and of course CNBC TV18 learns that the market regulator may be imposing a trading ban on companies that are undergoing insolvency proceedings, along with a whole host of other issues. Sandeep Parekh, the founder of FinSec Law Advisors, joins us now to talk about that. Sandeep, first up, what are your own expectations from the board meeting today?
So again, I'm basing my comments on newspaper reports which have come out. So I believe they're looking at exchanges and market infrastructure institutions and how they're governed, etc. They're also looking at listing norms, and I'm assuming that the Kotak committee report will also come up in part, if not in whole.
No, yeah, those of course are also on the agenda, but
and sorry, so the most
we were more interested in the NCLT related provisions
in the insolvency. Yeah. So I think that's kind of that's the most important, I guess, in terms of something which is very current. I think they're looking at a couple of relaxations to be given to many of these companies. Also, I think the issue they're probably going to look at the issue of whether trading should be suspended in these companies when it's going through the crucial phases of insolvency. So there's several issues, in fact, probably half a dozen important issues with respect to harmonizing with the insolvency process. And I think they'll probably have to take it up this board meeting, and they'll probably have to accept with whatever modifications today itself, because all of these are highly time bound, and unless Sebi is kind of playing ball, I think all the other parties would not be able to meet the deadlines. Okay.
No, the reason why we invited you is, Sandeep, Sebi has been a little aggressive, and perhaps correctly so. They even tried to have that single-day default disclosure, and now it has come via the RBI circular in a different way. It's quite possible that they will go ahead and even look at this IBC cases not being allowed to trade. If they indeed were to take such a decision, can it be done by Sebi? Are not legal amendments required?
Not really. I mean, the decision to suspend trading when something is going through insolvency is a decision I think Sebi can take under its existing regulatory framework. So I don't think they need to amend the law for doing that. Whether they should do it or not is, I think, the larger question. And my own view is that I don't think such trading should be suspended. I think even if at whatever rate people should be allowed to match make in the markets and figure out the price. I mean, we've seen in several stocks, we've seen the prices are nowhere close to zero. They're in fact fairly large valuations, given that they're almost definitely going into insolvency and highly likely to get into complete liquidation.
Okay. But Sandeep, two quick questions then. Is it more likely then that minimum public shareholder norm could be relaxed? Because a lot of them have huge debt, which if converted into equity, for instance, Bhushan Steel, you convert 40,000 crore, even a small part of it into equity, the Tatas will end up holding 95% or 90% in Bhushan Steel. So is it more likely that the minimum public shareholding norm could be relaxed for these cases? And does that require any other legal changes, or is Sebi's word the law? And secondly, if they were to go ahead and not allow trading, do you expect a lot of litigation?
Not really. I don't think there'll be much litigation. I mean, at most they can file a writ, and usually high courts are kind of in matters which require expertise. High courts usually don't interfere. And I think, on the general point, I think Sebi is empowered to do this, including suspending, listing, etc. So I think it's all, there's no statutory amendment which is required. As I said, the main issue is whether it should be suspended or not. And on the other question of, minimum public shareholding, I think they should extend it to, let's say, give them a timeline of, let's say, 4 years or 5 years, and then within that 4 or 5 year period time, who is the promoter brings it down to 75. And similar dispensation does exist already when through takeover or other means, it goes, the non-public shareholding goes up above 75%,
sure.
they are typically given 1 or 2 years to comply. So I think a longer time period would be more appropriate given, the near-death experience the company has just had.